Yesterday night, the Federal Reserve made its first rate cut since March 2020, slashing the Fed funds target by a hefty 50 basis points to 4.75% to 5.0%. While a rate cut was expected, there was debate over whether the Fed would opt for a more cautious 25 basis points reduction instead. The bigger question now is how this rate cut will impact global markets, including ours. Can we draw parallels from the last three major cycles when U.S. rate cuts followed severe economic crises such as the dotcom crash in 2001, the 2008 mortgage crisis, and the COVID-19 pandemic in 2020? Unpacking the past, how rate-cutting cycles have played out over time. During the 2001 cycle, the Fed slashed rates from 6.5% to 1% over 2 years, responding to the dot-com crash. U.S. markets suffered, with the S&P 500 losing 14% in 2001 and another 14% by mid-2003. During the 2007-09 cycle, the Fed slashed rates from 5.25% to 0.25% amid the mortgage crisis and massive job losses. U.S. markets initially held steady but later plunged, losing 38% of value. The 2020 rate-cutting cycle began smoothly in 2019, with rates dropping from 2.5% to 1.75%. However, the COVID-19 pandemic forced the Fed to slash rates to 0.25% in March 2020. Markets remained steady until early 2020, but plunged after mid-February as the pandemic unfolded. Unlike previous rate cut cycles driven by severe economic downturns, the current landscape is more stable. With stronger corporate and household balance sheets and healthier macroeconomic indicators, this cycle points to a more measured pace of rate cuts. Economists are predicting a soft landing, where growth moderates without tipping the U.S. into a deep recession. This time, rate cuts reflect inflation being brought under control rather than a response to crisis conditions. The Federal Reserve has also expressed growing confidence that inflation is steadily approaching the 2% target, with balanced risks to its employment and inflation goals. Rate cut implications on Indian market. The Nifty index has shown mixed performance during past Fed rate cut cycles. 2001, following rate cuts, the Nifty fell by 35%, reflecting weak earnings and a slowing economy. Sectors like IT, which had thrived during the dot-com boom, suffered substantial corrections. 2007-2008, initially Nifty rose due to strong domestic demand, but a subsequent global financial crisis led to a dramatic 60% crash. The economic downturn and recessionary pressures outweighed the benefits of lower capital costs. 2019, preemptive rate cuts by the Fed led to a flat performance for Nifty. The benefits from reduced borrowing costs were neutralized by weak global demand, moderate commodity prices, and investor caution. These trends indicate that Nifty's reaction to rate cuts extends beyond liquidity boosts. Factors like weak earnings, sluggish demand, and high valuations can cap potential gains. Cyclical sectors usually face challenges in downturns, while defensive sectors such as pharmaceuticals, consumer goods, and private banks tend to be more resilient. 10-year bond yields versus Fed rate. Historically, U.S. Fed rate cuts lead to a drop in 10-year bond yields in both the U.S. and India. However, the percentage changes in the U.S. 10-year bond yield following Fed rate cuts tend to be more pronounced compared to India's, where yields are generally less volatile. A Fed rate cut typically lowers borrowing costs, stimulating economic activity and increasing demand for bonds, which in turn drives bond yields down. Given the anticipated divergence from traditional rate-cutting cycles and the mixed historical performance of markets during such periods, investors should consider the following strategies. 1. Evaluate cyclical exposure. As sectors like industrials and metals may struggle in a slowing economy, investors could reduce exposure to cyclicals and shift funds toward defensive sectors like healthcare, consumer staples, and utilities for greater resilience. 2. Focus on quality. Invest in companies with robust balance sheets, consistent earnings, and low debt. These firms tend to perform better during economic downturns and offer stability to your portfolio. 3. Diversify internationally. Spread investments across various regions to reduce risk and tap into growth opportunities in both emerging and developed markets. 4. Monitor inflation and interest rates. They affect assets differently. Rising inflation may boost commodities but hurt bonds. 5. Adjust fixed income allocations. Anticipate rate cuts by favoring longer duration bonds, but be wary of interest rate risk if rates rise. 6. Rebalance regularly. Review and adjust your portfolio periodically to match your risk tolerance and goals, optimizing returns and managing risks according to market conditions. Thank you, and stay tuned for daily updates as we keep a close watch on these developments. Subscribe to our YouTube channel and follow us on LinkedIn for the latest insights and analysis.